This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. One of those troubling reminders comes up in today's podcast episode. Well, not too terribly troubling to me, but I really hate it when someone points out that the educational system isn't about the truth. That there's some other motivation. I mean, I've always known this myself, but the amount of money that the educational system spends, and I'm talking about the American university and college system primarily, the amount of money they spend to present themselves as above it all, well, that's just not the case. Just not the case. And looking at the battle, it is a battle. The battle between the efficient market hypothesis guys and gals versus the behavioral school, the behavioral economics and behavioral finance school. It's really interesting that in 2015, it's not yet about the truth. We're just not yet there. Today on the show, I have Victor Ricciardi. He's a professor of finance at Goucher College. He specializes in behavioral finance, behavioral economics. His very dense book from Wiley is called Investor Behavior. He's the editor on it. It is a massive, massive effort. All the detail in the world that one could want to wrap their arms around behavioral finance and behavioral economics. To me, in my world, this is some of my driving interest. I want to see how discussions on behavior are going, the new insights, the ways all of the research is going in the behavioral world. It's fascinating to me. And of course, from a personal standpoint, it dovetails perfectly with a particular style of trading that I'm interested in. An absolute perfect dovetail. Victor and I cover some wide territory today. I hope you enjoy this conversation. Is there an open-mindedness to the classical side now? Do they see, from your perspective, do they see a miscalculation or a wrong direction that they went, or an error, or do they view that the way they went can be explained just fine the way they've gone?
I would say you really have to look at who you're talking about. So, for example, my book, Investor Behavior, part of the major aspect of the content focus is on the financial planning industry and financial advisors. That branch of real-world decision-makers are very open, and they use many of the applications of behavioral finance. If you're looking here, say, in the United States, for example, and you look at the bigger business schools, which typically have what's known as AACSB accreditation, which are about 500 schools in the United States, they tend to still, I would say, the vast majority of the content and the PhDs in finance, because they were classically trained in this area, the vast majority still cling on to the classical decision-making. So maybe if they cover an investments course, they'll teach a behavioral finance topic, or a chapter in that for 1 week, but most of them are not trained. I would say, in general, most of them are not open to even having a behavioral finance course in the curriculum. So it's kind of, you really have to look at who you're talking about. For example, I've been in Europe recently. Europe is very open to behavioral finance. So it's just where they are in the life cycle, I guess.
So you're basically saying the big business schools, the big finance curriculum at the major universities in America are especially horse blinders on. We really don't want to pay attention to this.
I would say there's exceptions, but in terms of the standard content that's presented to finance majors, I would say that's definitely true.
And you know what's interesting, and I'm not trying to put you on a spot or anything, but I think the average person listening would say, but hold on, these are supposed to be places of higher learning. What are all these moats that are being dug around certain forms of curriculum? Why is there the openness? Why does that seem to be gone? I think the average person would really not understand how there can be such a rift.
Well, I mean, it really comes down to, as I was saying before, if you've been taught the same thing for 20, 25 years, if your PhD in finance is in a highly quant, rational, model-based approach to efficient market hypothesis, the idea of model portfolio, maximizing utility, if that's all you've ever been told about for 20, 25 years, and then somebody tells you something that shakes your world view of things, it does take a while, and I don't think it's any type of conspiracy. I think it's behavior. There's a behavioral reaction to the rationalists on even accepting behavioral finance. That's the way to think about it.
Hey, let me jump right into now your work, Investor Behavior. You're the editor. You have some material in there that's your material. You have a lot of pieces that you've pulled together and really have kind of laid down the only word I could think of was dense as I was going through. It's definitely dense. But let me jump into a topic area, at least in the beginning of our conversation, that's more to your heart, to where you're at in your work. And that is, you mentioned risk, but why don't you talk about the difference between risk perception and risk tolerance?
Okay, risk tolerance, and many people may, even if somebody's just a novice, and they've sat down with a financial planner or even online, there are many types of risk tolerance questionnaires, for example, and what risk tolerance deals with is typically what is the maximum amount of risk you're willing to accept for, say, as a percentage of, say, stocks in your portfolio, and then that breaks out, are you risk-averse, risk-average, or are you a aggressive risk-taker, versus risk perception is really looking at the behavioral finance issues. So, for example, there may be an emotional reaction to risk. You can ask somebody, for example, how they define risk, or do they think the stock market is risky? You'll get different reactions because they define risk differently. So, for example, if you don't ask somebody what risk is about the stock market, say you ask somebody, I've done a study several years ago, about 2010, online, in which I associated the word worry with risk. Instead of saying, is the stock market risky, we asked, would you associate worry more with stocks versus bonds, and that time was only about 3 years after the financial crisis, and about 70% of people of the sample associated the word worry with stocks over bonds, for example.
In my world, when I look at professional traders that have a longer time horizon, none of this high-frequency day trading stuff, people that have decades of performance that everyone can find their disclosure documents and all that kind of fun stuff, generally, I find the traders' risk is defined as loss. What can I lose? So if I'm risking $2, I can lose $2. It seems like such a simple way to do it, but I think many people don't want to go that direction. Your feeling when I throw that at you, say, okay, risk is how much I can lose.
Oh, I agree with you, and that's a piece of the puzzle. But also, again, it depends who you're talking to. If it's a client talking to a novice investor or a beginning investor, people, so for example, modern portfolio, where the rationalists would say beta is a central gauge of stock market risk. So if the beta 1.0, you say that that's the average stock in the market, or anything above that is more riskier, or below that. And that's typically based on historical risk. The risk perception, or as you're saying, people focus on, say, traders, they think about loss. That loss, though, is how do they quantify it? Is it a $2,000 loss, a $3,000 loss, or for many people who are loss averse, they also will define it as an emotional loss. So that loss can either be an objective number. It may be a subjective number, or it can be a combination of the two, depending on if people are actually losing money on something. So there's different reactions people are going to get to different circumstances.
As I'm going through your work, I kept thinking to myself, what's the best application? So, for example, I read some of these great terms, and I kind of know these terms from a trading perspective, not necessarily from the academic perspective, but they're the same thing. So, for example, the ambiguity aversion, the affect heuristic, the anchoring heuristic. These things are all in a good trading approach. These are all kind of foundational. And I'm curious, when someone who is in behavioral finance, behavioral economics, and you're looking at application of all these great ideas and these great principles, it seems like to me that the best applications are ultimately going to be systematic approaches. Because I think the moment that the human being is on a discretionary basis, on a daily basis, trying to adjust on a daily basis, either they're investing or they're trading, it seems like you fall into all the traps, all the biases and whatnot that behavioral finance and behavioral economics has risen to the forefront to help to explain. Do you see where I'm going?
Oh, yes. I mean, especially if you're a trader, the idea is you said to have a systematic or a disciplined strategy. And it's the same thing as even if you're by yourself as an investor. And for me, even myself, I thought I was a traditionalist, and I started to realize that I traded too much. I started to realize that I checked my portfolio too much and that I moved around my money too frequently. And then, so ultimately, over the last, I would say, 10 years, is I actually like many of the tools of the rationalists. I just don't agree with necessarily the underlying assumptions. So my approach, similar to maybe as a trader of what you're alluding to, is behavioral finance helps me understand my investment mistakes. So I take a long-term investment strategy using the tools of standard or traditional finance, but I agree with their outcome. I'm trying to use these biases to act rationally, is my perspective on it.
Talk about, for example, I just love the idea of the affect heuristic. It's basing decisions primarily on intuition, gut feel, instinct. There are so many people that think that gut feel, instinct, intuition is the way that they should march through their life with money and markets and risk online. They think this is the direction they should go. And there's just all available evidence says you do not want to be sitting there relying on your gut on a daily basis to make decisions.
Well, and actually, the affect heuristic is even a further extension of that. There's an emotional component, as you were saying, but also it's a combination of taking, and again, just to make everybody on board, a heuristic is typically a cognitive mental process in which we use to make decisions, to make sure listeners will understand that. But then what you do is you combine the emotional part of the brain. So, for example, if you look at something and you're just kind of looking at the objective aspects of it, and there's no emotion involved, that was the initial underlying assumption of behavioral finance. Then, say, in the 1990s, they started to look at the emotional reaction, and then so the affect heuristic is saying, we're looking at the cognitive or the practicality of something or the analytical side, but then we look at the emotional side. So a perfect example, I think, is, say, from a consumer's perspective. You're going to buy a practical car. You do the early analytics. You know that you're going to buy the car with the best record of maintenance at the cheapest price. But then you go into the car dealer and you see the shiny red sports car that the average American, say, in their 40s is going through a midlife crisis. The emotional aspect of that sports car overtakes the rational or the heuristic mind or the heuristic perception, and we go with that emotional or the intuition aspect of what you were alluding to.
Hey, is that midlife crisis thing still in operation? I'm in my 40s. I didn't know that's still going on. I thought that was over.
Well, I didn't say it was absolute, but maybe maybe it will happen in your 50s. So let's hope that you live to 100. How's that? Maybe that's your midlife crisis.
I like also, too, the notion of the anchoring heuristic, basically holding on to the initial and not making adjustments. And I think from a trading perspective, a great way to look at that is, okay, I have $100,000, but then for whatever reason, markets don't go my way, etc., loss builds up. I now have $75,000. And all you have is the 75,000. The 100,000 doesn't exist anymore. The 75,000 is the real, and that's very difficult for people to accept, isn't it?
Oh yes, and it even makes them, and that's what the loss aversion experiments show, that people then, depending on, and again, it's not everybody, it's a certain category of people, when they have felt the loss, they hold on to losers on the downside too long, or say if they're trading a margin or a loan account, they wind up buying more of the position. So they wind up taking potentially more losses, but also they're even less diversified, and then they're essentially risking their overall financial health. And that just shows you, for example, people do not always think if they're making an individual trade in which they're risking a lot of money, they don't think about that individual trade in the context of their overall portfolio.
By the way, I hope you don't feel any discomfort at me jumping around. But as I mentioned in the very beginning, your book is dense. I mean, I could literally go in thousands of directions. Hey, listen, one thing I'd love for you to define for me, Professor. I hear the terms and I assume they're interchangeable, but are they? Behavioral finance, behavioral economics, are they interchangeable?
I think it's similar to even on the traditional side when you have economics and finance. Finance is still going to deal with more of the investment decision process, so corporate finance, personal finance. Economics has overlap, or really any type of economics or behavioral economics is the foundation of behavioral finance. But there are many economic issues that may not be financial in nature. So somebody has a problem with a drug addiction, and that affects, say, the impact of government spending, for example. I would view that as more of a behavioral economics issue versus, anything such as finance related would be investments, corporate finance, personal finance. But I wouldn't, if you're writing a paper on behavioral finance, you still look at many of the findings in, say, a behavioral and economics related area to help build the foundation of what you were doing.
Yeah, I see some of this sometimes in the descriptions of trading styles, and I was going to bring this up, but for example, you can see terms like momentum or macro trading, managed futures, CTA, trend following. You can see all these different terms, and sometimes there's great overlap, if not the exact same thing. Sometimes there's not.
Exactly, and then even when behavioral finance and behavioral economics have become common among the people who practice it, and many times they won't even mention the term in, say, a paper or an article. So it's just, even if you're just reading something about emotion and financial decision making, that would still be considered a behavioral finance paper or news story.
There's another one that I just love, which is the disposition effect. And the notion of selling your winners and holding on to your losers. Now, for any trader out there, everyone knows, let your winners run, cut your losers short. Why could you not, behavioral guys, just gone ahead and stuck with the phraseology and the terms that we already know? You gave it this really cool term that no one understands until you read the definition. You're like, well, I know that.
Well, there's several biases going on. There's you mentioned anchoring. So part of, if you had a chart, you anchor the individual trade, and then that trade, as you said, may wind up making money or losing money. So initially, the studies only thought about, and typically the loss aversion works this way. On the downside, a $2 loss is twice as painful than a dollar upside. And so, for example, if you made $1,000 according to the rationalists, $1,000 loss would feel equivalent. The work of Kahneman and Tversky shows at the downside, though, $1,000 gain on the upside is a loss. Feels like a $2,000 loss on the downside. And that was, as I said, those original studies in the 70s, 80s were really just really focused on the cognitive heuristics of it. Then people added the disposition effect, as you said, later on, but then also the loss aversion topic then started to deal with emotion. So on the downside, we regret the idea of making the investment or even disclosing it to, say, it's a friend. But on the other side, we think about the pride of making those investment decisions. But especially on the regret side, the emotional aspect of that loss aversion really has a much greater weight on our decision-making process.
I'm curious, is there any behavioral work that takes a good look at different strategies, different trading strategies, different investing strategies? Because to me, it seems like not all strategies are created equal, and some strategies seem to have a much better handle from their foundation, from the way they've been devised, a much better foundation on these many biases and heuristics that we're talking about than other strategies. And I guess I would point back to discretionary type strategies. That's not to say that we all can't pull up the Wall Street Journal or Barron's and find some example of some billionaire who made a fortune and will say he did it discretionarily. But that's not the point, is it?
No, and I would say that if you think markets are inefficient partially, you would look at something like there's an overreaction in stock prices. So many times you can make money, and there's some research that shows, for example, if you go with a momentum strategy or investor sentiment, that if you ride that for, say, a year, sometimes you can make additional returns. But it's, again, you have to have that disciplined strategy to actually get out of the stock in a year, for example. Another, I think, aspect of it is another major overreaction or underreaction is to earnings prices. So that's another way people may, even whether it's an investor or a trader, makes money using behavioral finance strategies. And I think the other big one that's mentioned in the book also is the theme of value investing or contrarian investors. We are primed, whether traders or investors, the vast majority of us are growth investors. So the other behavioral bias that we suffer from is many times people don't take into account the contrarian view or the value view as another way to make money in terms of investing or trading.
Hey, talk about behavioral economics from the standpoint of explaining asset bubbles and the popping of asset bubbles. You view behavioral economics as a better tool to explain those bubbles and bubbles popping than the efficient market hypothesis, yes?
Exactly, and that's where I think the capital asset pricing model, the idea of looking at beta or historical returns, those models work very well in calm or average markets. So if you're in a market with a normal distribution, which the market is acting in a given year that it does 95% historically, I would say you have some efficiency in the market. The problem, though, is those models start to break down when you have those periods of a bubble in which you're making 25, 35% returns versus when the bubble bursts on the downside of a bear market, you have losing 20 to 25% returns. That's where I think the behavioral stuff really comes on the more robust findings on the market level. And then on the individual level, the rationalists talk about people being rational, but they really don't even study the individual. And that's where I think the behavioral bias also, if you're dealing with that client or that group decision-making process, or as you're alluding to, the trader, suffer from many of those biases.
Excuse me for jumping around, but you have so much cool stuff. One of the things that I thought was really, really cool, because I'm calling you from Asia right now, and I'm about an hour and a half flight from Singapore, which I think is now, maybe because of median income or whatnot, is at the highest level of median income. I think they've passed Switzerland. But, it's funny. Many of my Singaporean friends, I don't necessarily detect this pure happiness And I thought this great concept that you had referenced in your book was the Easterlin paradox, which is economic growth does not increase with happiness. It does not increase happiness. And I think that's really interesting. Why don't you talk about that?
Well, I think it's also a reference to also the notion of individuality. So, I mean, if you're trying to tie, say, something like a macro piece, if there may not be enough findings to say necessarily support that, but also on an individual level. So, for example, here in the United States or abroad, many of the vast positions, and I was even looking at data recently from the Labor Department here, many of the vast positions here are occupations in which many people make lower or very low average salary. And those people then are going to look at somebody who's upper middle class. There's really, and then here it's talking U.S. dollars because I know it's an international broadcast, but for example, here in U.S. dollars, the break-even point for happiness is typically thought about being $75,000 to $100,000. And then people said, oh, my students asked me, why is that really, it doesn't seem like much money to them. But then you start to delve into what the average person makes for the wider employed industry. So, for example, here I saw something like cashiers and retail clerks. Maybe their average salary is $45,000, $46,000. So many people who think necessarily wouldn't even I don't even know how to reflect to be, say, a millionaire. If you tell them that you're going to double the average salary of that population, that's a pretty good aim or break-even point. So, because I don't think many people can actually relate to what higher income is, because a vast majority, no matter what the country is, still only maybe 10% of the overall population would fall into that category of higher income, if that makes sense.
Yeah, no, it does. And I should add, as you mentioned, the U.S. dollar, you're not getting any complaints from me about the U.S. dollar right now. I know it's not necessarily going to stay where it is, but I have to tell all Americans out there right now, there's never been a better time to travel. You should leave the country right now with those dollars while they're worth as much as they are, because there's no guarantee that you're going to have that value forever, because these things go up and down. Mm-hmm. Let's talk about, we mentioned the idea of bubbles. I want to expand on that a little bit more, and the notion of tails, because you were talking about a normal distribution. And it seems like to me that there's so much evidence, and you can contrast this with the efficient market hypothesis, but the notion of the tail, there's so many extended tails to the right side and the left side. Now, if you get to the right side and you can make a good chunk of money on that right edge, that's great. But I think a lot of people forget about the tail on the left side as well, which is not a good thing on the left side.
Yeah, well, again, people don't always think in terms of downside risk. Even if you're making, risk could even be defined as if you're making above average returns, above what your mean or your average return would be expected in a given year, that could also be defined as risk, because if you are getting above average returns, many people are then not going to be thinking about risk when the market turns. But also, what above average returns above your mean, what it's resulting in is many times, if that happens for an extended period of time, such as, say, the internet bubble here in the United States in the 1990s, people then get outside their risk tolerance category. So, for example, if you're a conservative risk taker, and you've had 5 years of above average returns, and you made no allocation or no shifting or what we call rebalancing in your overall portfolio, you may have initially been in a category of being risk conservative, but at the tail of the bubble, you are then probably a very aggressive risk taker if you essentially did not do rebalancing. But what I like about rebalancing, especially if you're an investor, is the idea is you're hitting the brakes because you're forcing yourself on a yearly basis. Similar to gambling, and many people do not take money off the table. They keep on letting it ride. So if you keep on letting it ride, at some point you feel like you even have a greater wealth effect, but when things start to turn and you don't want to take the loss, you wind up panicking at the very time you should be buy. The whole idea is to buy low, sell high. Many times people rush in with a bubble and they buy high, and then they wind up selling low. And once the market recovers, they've been so burnt or they've had so many losses, they're completely out of the market and they miss the complete turnaround also.
It's fascinating that after all these years, all these decades of us knowing the right way to do things, we still don't. And I thought a great place to go would be the notion of animal spirits. And I'll let you define it and kind of teach for a second. But I would also be curious, as if you're going to talk about animal spirits, give me your opinion. When they handed out the Nobel Prize, wasn't it last year? And they said, okay, Professor Fama, Professor Schiller, here you go. It's split. Well, there was another professor too, but did that strike you as unusual? Did it? I mean, it seemed like here we are at a time and a place where people would love to have the ability to move forward, and it seemed like the group out there that rewards the high level thinking for the average person, not the academic, but the average person is probably saying, "Well, that doesn't make any sense."
Well, I think what you're doing is you're getting both with the awarding the Nobel Prize, because essentially what you've gotten is a representation of the classical school along with the idea of the behavioral school. I mean, Robert Shiller essentially did a very good job of calling bubbles and saying that if you look at rational models or historical matrices, that there's a bubble in the market. And that, for example, there are ways, even if you take something like accounting data, for example, and you said, talking about something like price earnings ratio, book to market, that even those simple historical ratios, financial ratios, are very good benchmarks for actually identifying bubbles in the market. I mean, if you look at the internet bubble of the 1990s, and we're not even talking about the internet companies, most of those didn't even have earnings. We're talking about historical technology companies. Some of them had P ratios of 70s and 80s. And some of our historical, technology could be anywhere from a 15 to 25 P ratio. So again, you have those indicators that you have bubbles, and people still follow the herd. They still use those animal spirits, and at some point, the market will turn into a new from a bear to a bull market, from a bull market to a bear market. But people don't recognize it when it's happening, and as I said before, they don't want to suffer the loss or the realization that potentially that the party is over, and no one wants to also burst the bubble or burst the party.
Let me ask you one last thing, Victor, because I don't think you really wanted my question about asking the reason for the confusion, perhaps, to the average person viewing the handing out of the Nobel Prize. But talk about where you see this debate going in the future. I personally don't see how anything but the behavioral approach continuing to expand and gain ground. And I don't know, at some point in time, you mentioned the 500 largest schools in America generally stick to the classic approach with exceptions. But I'm curious, I would see in the future that the behavioral approach, it just seems so, frankly, the behavioral approach seems so logical. I don't know how we can not see more and more progress, or people see the benefits of this type of thinking and understanding for their lives.
Well, I think that the biggest hurdle, and this is even though I'm a behavioralist, but the biggest hurdle we currently have is we need better tools and better models in which people can actually use as tools. So, for example, as we talked about, the idea of measuring risk, you put everything in a rational school, you put everything in the capital asset pricing model, it produces returns, and you get a conceptual application to being able to crunch large numbers. and there's some initial work in it, but what we essentially need, for example, a behavioral capital asset pricing model in which people can find objective numbers that are psychologically based and being able to then plug them into a model. That's where I think the field, when someone actually comes up with an equivalent, one-for-one different models and that can compete with the traditional school, that's when I think you'll have a wider acceptance of behavioral finance. But also as time goes on, people are going to understand more psychology and other things. So, and also, I guess I view it differently. I don't necessarily, I think as academics we get too enamored with a contest or a brawl or a war. I view it as if you combine the two disciplines together, you actually create a better branch of total finance. I just wish, or the way I even teach it, even though I'm a behavioralist, I try to give my students both sides of the issue, and I say to them, if they're very analytical and they're not emotional, they like the traditional school. So I completely support them in that. But what I think we do a poor job as educators is not giving our students the ability to learn about both schools of thought and let them make up their minds.
I'll offer one last thing, just a piece from my world as I look at some of the trading strategies and one particular trading strategy in my world. And it's fairly simple. You'll find a trader who's looking at a diversified portfolio of commodities that could be gold, corn, coffee, interest rates, currencies, energy, having all these markets in your portfolio and waiting for markets to move, not having a preconceived idea which way the markets are going to move. So, for example, when oil collapses in 2014, these particular strategies are capturing a good piece of that short. Now, there'll be other times when they might take a short position that goes against them. They lose a small amount of money. So you really have a strategy where your winners are maybe 30, 40% of the time. Your losers are 60 or 70% of the time. But you find a positive mathematical expectation because your winners are 3 to 4 times larger than the losers. I think it's so fascinating. When I'm going through your work, I'm just like, wow, this particular style of strategy is seemingly the traders knew about behavioral finance before the academic literature put it out. They seem to have understood that I need to have these rules. I need to have these disciplines that I stick to, or I'm going to fail. I'm not gonna make it. And so I just found it fascinating going through your work and just seeing the applications from my perspective.
Well, thank you. And again, I'm a co-editor on the book Investor Behavior, The Psychology of Financial Planning and Investing, and also Ken Baker, my co-editor, I just wanted to mention him. And also, there are essentially 45 people who wrote the 30 chapters, so they certainly deserve a lot of the credit for this book, so I always like to mention that. But also, again, honestly, we don't make much money from the royalties of this book. For me, it's a volunteer or a donation to the profession in which I take a great deal of pride in putting a lot of effort into this book, but also it's just nice to know that people are actually reading it.
Yeah, it's dense. It's dense, and it's definitely a reference guide. It's worth having on your shelf if you want to start to understand all the work that all these many people have done. Like you said, that you've edited, you and your partner have edited together. Quick question, Victor. Where can we send people? The book's on Amazon. It's called Investor Behavior. It's by Wiley. But where can we send people to find out more information about you, see your white papers, your current research? Where can we send them?
Well, the best way to actually see most of my research is I'm very active on Twitter. So if people actually just search the term behavioral finance on Twitter, my name should come up. Or if they just search, or essentially my username is my first name, Victor, Victor, and my last name, Ricciardi, Ricciardi. Or if you just Google me and you look for a Twitter account, it should easily come up. I have over 70,000 followers or something.
Yeah, someone's been working. I'm telling you right now. That's That's no easy accomplishment there. So congrats.
Yeah, and all I'm posting essentially is some of my research. I look for a lot of news stories on personal finance, a lot of research related stuff on behavioral finance. So for me, it's more of I've really no agenda with worrying about pushing any type of investment strategy. I'm just trying to post news stories to try to educate people, and I have no conflict of interest. I don't take money I'm not an investment advisor, so mostly what I'm doing is I just want to try to educate the individual investor to make the best possible decision.
Yeah, I will second that. You definitely are you're not promoting any particular type of strategy in your work. You're laying out the behavioral issues that we should all know about, regardless of how we decide to utilize our money in the markets or not utilize our money. So it's an unbiased view, and it is what it is. And people have to then decide how they best use all that information in their own life.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.